Hello and welcome to the Technical Analysis Masterclass. You're going to learn here everything there is to know about technical trading and technical analysis, how to read charts and patterns and understand what they're telling you. We also are going to learn a lot of different indicators to help you become a better trader or investor, but the main goal is to give you the confidence to apply technical analysis and use it yourself, particularly the right way. So this is a list of the various modules we will cover in the course, and each of them has several topics that will be covered within, which makes it a truly comprehensive course that can be completed at your own pace. We begin by covering the fundamental concepts of technical analysis, and then move on to price bars, which is pertinent for any aspiring technical analyst. Module 3 will go over trading gaps, which are when prices spike dramatically up or down, and the opportunities that they provide. Candlesticks, which are price bars that they look like a candle with wicks on the top and bottom. So we'll learn how to read them, trade them, and the various patterns they offer. You may have heard the phrase, the trend is your friend, and there's a reason for that, and we'll discuss trend lines and how to properly set them up on your chart to maximize their effectiveness. Chart pattern recognition and how to trade them. So many times you'll see a specific pattern develop on your chart that can anticipate where price is going to go next. Moving averages, which are my preferred indicator and are very easy to understand, making them a great tool for beginners. They give you the ability to tell whether to buy or sell based on the relation to price, for example. Momentum indicators, they show you how quickly something is accelerating in terms of momentum. Volatility, how wide the price range is up and down, and how we can use that to our advantage, along with the indicators and tools that go with it. And then some strategy stuff, like how to get better results using multiple trading tools and how to put it all together. How to develop a trading strategy that is truly your trading strategy. How to create one that works for you. How to manage your trades and the various types of orders out there. When is the best time to use different types of orders? And then we'll wrap it all up with top 5 action steps and some closing thoughts. So it's a great course. It's a real complete course that I'm excited to really get into and glad you decided to join me. It requires no prior knowledge of trading in any shape or form. It was designed to provide that foundation every trader should really have. And in terms of getting the most out of the course, I would highly recommend taking notes as you go along. It really helps that information stick. It doesn't have to be long or detailed, but maybe if you hear something that you think could be important about a moving average indicator or something like that that you just found interesting, and you want to use that information to look at some charts that you've been watching recently. Like, for example, I want to look at the 10 moving average on my favorite stock. So just a quick note like that can help you as far as reinforcing what you've learned, and studies have shown that even the aspect of taking notes helps with better recall. So even if you never looked at these notes again. So I've always been a big note taker myself, but it's completely up to you. Just figured I would share the idea. So let's get started and dive into the course and learn some of the key concepts and ways to set ourselves up for success by using technical analysis in trading stocks. Let's talk about why technical analysis works, and it works very, very well most of the time, but not all the time. And so we'll get into that and kind of the underlying concepts around technical analysis. And a lot of it gets back to the whole idea of supply and demand. If you have a lot of demand for something, the prices will rise up. A whole bunch of people are buying a certain product, for example, and the person who sells the product could raise the price. And the same thing with trading of a stock. If there's a lot of demand for the stock, the price will rise. And so what this leads to is that supply and demand has predictable behaviors. If we start seeing certain patterns or certain things happening, we can anticipate that there's going to be changes of things that are going to happen as a result of that supply and demand. And it's been around for a long time. I'm sure everyone's heard of the Dow Jones Industrial Average. It's made up of 30 US blue chip companies, so like top of the top. Well, it was developed based off of the Dow theory concept, which was heavily based around technical analysis, and this was based back in 1902, which is pretty cool. And the oldest book that I've read covering technical analysis dates back to 1948. So it's not like it's just something brand new that has never been really proven or tested. It's been used for a very long time. In fact, some things like candlestick price patterns and all that go way back hundreds and hundreds of years back in Japan. But certainly the term technical analysis since 1948, and many different things around that proving why it works, but not all the time. So let's talk about what's the idea behind this. And one way to think about it is, how people kind of travel together, or people will invest together, or traders will get an idea and they'll kind of start moving together, right? And that's kind of what we think about as trends. Everyone kind of all moving in the same direction. It's almost like a herd mentality. So I'm not going to say that people are like sheep, obviously, but it's the idea of a number of people or animals traveling together, going in the same direction. So like if you look at this picture, for example, you could see that these sheep are traveling in a certain direction, right? It's obvious. They're headed downhill on a road, and it's nice and easy for them to walk down that road. And they're all kind of headed in the same direction for the most part. And you can even consider that momentum investing, right? And we'll talk about momentum indicators where they're all kind of headed in this easy trend going down the hill. But you might also notice something that's going on there that's a little different in the upper left. Do you see the little patch of grass there on the left? There's a few sheep there. Now they are not following the trend. Like if we were investors, we might say that this is a definite downward trend, right? See how everything's kind of moving down the hill, and it's easy to move down that hill. But we want to watch what's going on that patch of grass over there, because that might be what we would call in technical analysis a breakout or a change of trend. And then the question is it going to be a real breakout? Is it going to change the trend? Are the sheep going to change the direction and now go to the grass? So if we think of this as terms of a stock, let's say prices have been falling, going down the hill, but now something is happening, something in the news, or people are just for whatever reason starting to change course, changing that supply and demand, then they're going to now go towards that patch of grass and prices are going to start to rise. So if we have an indicator that says, oh, when certain things happen, prices are going to start to rise, kind of the idea of like if we see enough sheep go up that hill if we see enough sheep go to the grass, then the rest of the sheep will start to change direction too. So maybe it's a breakout, maybe it's a trend forming, maybe it's just a retracement, which is another term for just a temporary move where it kind of goes up for a little bit, then comes right back down, which we're going to learn all about that. So that's the underlying idea of why it works, because it's looking at these big kind of macro type trends. Now, it doesn't work every time because, for one, nothing's 100% perfect, of course, but then there's unexpected random events that can occur, and these random events could be something that comes at a company level. Let's say the CEO unexpectedly dies or gets fired or something like that. And then there's something that can happen at a company level with regards to maybe an earnings announcement unexpectedly coming in lower, causing prices to tumble. But there are also things that can happen at a country or global level too. That are really beyond our control and even beyond our analysis. Things that the market simply can't factor in ahead of time. Because if something really unexpected happens, and I mean, if we think about something that was really a big unexpected event or had a certain shock to all the major markets for the time being, like for instance, COVID-19 back in 2020, we had COVID-19, and if you look at this chart here, Apple stock is in the teal, and then we have Carnival Cruise Lines in the red, and then the S&P 500 in yellow, which is made up of the top 500 stocks in the US. And on this chart, we could just kind of compare them. And if you look to the left, the lines which once again represent their prices are all moving in the same general up direction, kind of trending together. And then in February and March, it becomes known that COVID is really going to become a problem, recognized as a global pandemic, and sends all the prices down. So no matter how good of a stock you may have been in, everything falls down because there's this big unexpected event that the markets have never priced in. Now, once the event happens, then things change or can change, and you could see where people would look at Apple and see that it's at a bargain, right? In a pandemic where we can't go out and where we're all locked up and want reliable technology to use for work or entertainment, where are you going to buy from? Probably Apple or Microsoft, which is great for them. And as you could see, Apple's price took off for the rest of the year from that and other variables. The S&P also rebounded a bit too and actually finished the year up a bit, but if you look at Carnival Cruise Line, they went way down and hadn't recovered at least during that year of 2020. Maybe a little bit of recovery, but not a lot because, again, this unexpected event had a bigger impact on certain industries compared to others. I mean, who wants to be on a cruise line during a pandemic? And remember, the early stories about COVID-19, it was people trapped on cruise ships. They couldn't get off, they couldn't get home, and this is all while COVID was raging. So you could see the impact of this unexpected event happening. So sometimes this kind of stuff happens, and you're going to learn about how we are going to put in a built-in protections or have preventative measures in place to mitigate losses through stop-loss orders, and how we could recognize these trend changes as they're happening so we can make sure we get out. Technical analysis is about buying at the right time, but also selling at the right time and avoiding big losses like that. So again, nothing is 100% foolproof, but having an exit strategy is certainly going to help. If you had no exit strategy with Carnival Cruise Lines, you rode that way down. Like, I think it was down 83% or something. And if you're like, say, a buy and hold investor, which is different than trading and most certainly different than technical trading, you'll suffer through that and just hold through that whole duration. You just never get out and you try to ride out that storm. Now, you could see Carnival Cruise Lines goes down quite a bit. It's going to take a lot longer to ride that storm out than, let's say, Apple would. And that's to say if it ever even does return back to where it was prior to the COVID hit. But with technical trading, the idea is that I'm actually an active trader around that. So another thing with technical analysis is it doesn't tell you how much to invest. It tells you with indicators whether you should invest and how, but it doesn't tell you how much. And we will talk a little bit about some money investment strategies at the very end of the course to help you with that. But the actual indicators and things don't tell you, like, if I see this price bar, for instance, or I see this moving average go in a certain direction, I should invest X number of whatever money I have. It doesn't tell you that kind of stuff. It just tells you what's happening, and then you decide what action you want to take based off of that. So technical analysis is terrific. It's been around for a long time, but like with anything else, it's not perfect, so you have to understand it well. Let's continue to lay down some of the key foundational concepts. Now, if you already got a good handle on how to read a chart and you understand all these things, then you can go ahead and just skip this section. But let's talk about some of the real key foundational things. And I like to think about it like there's these different tools and things that you can use. And a lot of them are free, by the way. So many charting platforms offered are completely free, and everything that you see throughout the course can be replicated for free too. But if we think about it, you can almost think of like an artist, for example, like the canvas that they paint on. Well, that's a chart, right? So that's where you are looking at prices. That's where you're looking at the prices and some of the charts and things that we saw. So that's the overall chart. And then how you interpret or read that chart is where you use tools. Just like an artist might, paint with a paintbrush to kind of, in effect, make it come alive. We use tools like that in technical analysis. Price bars, candlesticks, lines and trend lines, indicators like moving averages, volatility indicators, momentum indicators, all sorts of different types of things that we're going to learn about in the course. But think of it that way of like, I got my canvas and then I'm going to apply my tools, and that's going to help me decide what to do. So let's start by looking at a chart and understanding what a chart is. So think of it as that blank canvas when you pull up a stock, and then it fills in your chart, and now you can start interpreting it. But you have to be able to read a chart too. So let's look at a chart here. This happens to be a chart of the S&P 500, which is made up of 500 US based companies, but it could really be a chart of anything. It could be Bitcoin, it doesn't matter. But I chose to use this one just for demonstration purposes. Now, first, you might look at this and it might be a bit overwhelming because it seems pretty complex, but don't worry about it. We're going to walk through all the different components, and as we go through the course, lots and lots of examples, and you're going to feel like an expert by the end of the course. So let's walk through different parts of the chart so you can kind of get a feel of how they work and function. So first off, if you see at the top here, that's just the name of the symbol. So this could be a symbol of a stock, a currency, it could be Bitcoin, Ethereum, whatever. It's like a shortened form you would call a ticker symbol. But if you put in the full name, the program will automatically pull up the symbol for you. So you don't need to memorize all that stuff on your own, but you kind of just do that over time. So if I were to put in, like, let's say Microsoft, it will pull up the stock automatically, so you don't need to remember that symbol. That's generally how most modern charting softwares work. And to the right of the symbol, so right next to where it says SPY, you have the time frame or the period. And on this chart, we're looking at daily prices. You could change that to daily, weekly, monthly. There's a whole array of options there. But when you look just below on the chart, you could see a little bit of information like what's the daily high or what the daily low was, that kind of stuff. So that's the basics just to get started with. But if you look down at the chart itself, I put some layers around, so as we walk through the chart, it's just easier to follow. So what you'll see on the chart is on the right-hand side, sometimes it's to the left, but typically on the right-hand side, you're going to see the prices. So right where that letter A is. And this represents a range of prices that this stock has ranged over a period of time. But you could look across horizontally and look at a certain price point and see what it was trading at on a particular day. So the price is on the right hand side, or the vertical axis. Now on the bottom, or the horizontal axis, indicated by the letter B, you have the time frame. And the time will go from the left to the right. So past to current. So let's say this chart is showing 50 days. 50 days back would be the far left, and the most recent day, the far right. So it gives you an idea as far as when time and price intersect on whatever stock was trading at that particular time. So if you look at, let's say, letter C, you could see that it's somewhere around the range of the $340 mark. So that's that. Now, if you look at the letter D towards the bottom of the chart, those bars are what represent volume. So how much are people trading? How many active people are trading the stock with regards to buying and selling? So it shows you that on some days they're trading more frequently than others. You see how some of the bars are much taller? That means there was more trading volume on those days. And in technical analysis, when there's a lot of trading volume, it's telling us that something's happening that we should pay attention to. And we'll talk about that as we go through the course, but that's just something to note with regards to volume. And you'll see that on the chart, you can have indicators that overlap, like the letter F. You'll see those lines that are overlaying the chart. Typically, you would just see a price bar, price peaks and valleys, but you can overlay the chart with indicators, as you can see here. And to give you an idea of that, I overlaid these lines that represent the 50-day moving average, which is the yellow one, and then the red line, which is the 200-day moving average. And we have a whole section on moving averages because they're just such a great indicator. But basically, you're looking at what the price has been averaging over the last 50 days or the last 200 days. That's why the lines are kind of moving different of one another. And when a price bar or candlestick crosses over the line, and that could tell you something, whether to buy or sell, or if the two lines cross each other, that can also tell you something. But for now, all you need to know is that there are things you can overlay your chart with, and you're going to learn all about them and how they could be effective with regards to helping you decide whether to buy or sell. And if you look at the letter G on our chart, that's where you can add indicators that don't overlap the chart. And this one happens to be the RSI, or the relative strength indicator, which we're also going to cover in a later lesson. And it gives you some additional level of vindication whether you should buy or sell. And if you look at the RSI indicator to the left, you're going to see how the line kind of moves out of that range, that purple range, which, by the way, this is not the price of the stock. It's a different kind of representation that we'll learn about later. But if you look at where it peaks above that range, that's where it's telling you that it might be time to sell. And if you look straight up from that peak, we could see that that's where prices start to really lose momentum and begin to move down. So if we look to use this relative strength indicator, we could kind of confirm or look to say, you know what, we've had a nice run up in prices. They might be getting a little high now and due for a pullback. And this relative strength indicator, which is an indicator we use that's based on math and technical analysis, is telling us, hey, we might want to watch this. We might even want to sell because we could be running out of steam. So that's the general idea of charts, how they work. And if it still seems a little confusing to you, don't worry about it. When we go through the course, I'm going to go through plenty of charts and walk through them all. And with time, they're going to become easier and easier for you to understand. For a lot of people, what's kind of a hang up is like, what time frame should you use? Or how far back should I look when I'm trying to evaluate my charts? And what kind of trader am I? How frequently do I trade? And does the time frame impact that? And it does. The length of time that you consider for your technical analysis can change the way you look at things, for sure. You could look at things based on minutes, real quick changes, or then there's hours or days, weeks, there's even months. And while the concept of universal language will be the same, how the chart looks and how you interpret it might be different if you're looking at, let's say, hours in a day versus, many days in a month. And there's terminology around all that, like swing trader, day trader, or a position trader. But for now, you don't have to worry about any of that. You may already even have a general idea if you want to be a day trader because you like to be in and out of trades quickly, or maybe you want to be in the trade a little longer, maybe be a swing trader. Whatever it may be, don't worry about it. You don't have to pick that time frame right now. You kind of pick that as you go through things and you start paper trading and practicing back testing and all that. You might find that you actually like or gravitate towards another one as you get through the course. And again, the tools and the indicators will apply no matter what the time frame. So for example, a day trader would constantly buy and sell during the day. They're constantly buying and selling, and at the end of the day, the whole idea is that they're going to be out of all of their positions and not carrying anything forward, no stock or anything, into the next day. So for a day trader, their time frame, because they're going to be targeting that day specifically, they're generally looking at minutes or hours. They're not going to be too concerned with the weekly or the monthly time frame. So again, there's not really any right or wrong answer to what time frame you target, but it's just generally that's what a day trader would target, is the shorter time frame. And if you're going to be a day trader, you're going to adjust your time frame to what's most optimal. And at the end of the course, we'll talk about this in more detail as we can then apply concepts as far as trading goes. So a day trader might think, I'm a short-term trader, so they look at minutes and hours, and then a swing trader might say, I want to be involved in a trade for a couple days, and they might look at days and weeks and even months. And a buy and hold investor is more so going to be, they'll buy a stock that they like when they feel that it's at a good price, and then obviously they're going to hold it. They're not really even looking at charts, most of them at least. But if they do, they would be looking at weeks, months, or years. So you don't really have to worry about picking your time frame too much right now. Like I said, it's going to happen naturally as you proceed through the course and as you play around with charts more. One thing that's important for technical analysis traders is the understanding of breakouts and retracement, and then the difference between the two. Now, normally you have a trading range or price range where you have a low price and you have a high price, and the stock will trade within that range over a period of time. And again, that period of time could be hours, days, weeks, or months, but price will tend to stay in that range. And you might have some general trends within that range where it might be flat or kind of going sideways, or you might have a general uptrend, or you might have a general, let's say, downtrend kind of within that broader range throughout that time frame. But then there's things that can happen where it could break those general trends and start reversing or going into a different trend. And then you need to figure out if it's truly happening or if it's some kind of fake move. And that's very important for us as technical traders to help us know when to buy and when to sell. So if we think about it conceptually, trends will continue until the pattern breaks, right? So something's got to break that pattern. And a lot of times what causes a stock to break out of a pattern is some sort of catalyst. So something in the news, for example, an earnings announcement, something on a global scale, or even just a rumor might have what it takes. And that's the idea. Something happens, there's some news or rumor, and then traders react, and let's say they panic and think to themselves, I have to get out really fast. They'll start to sell off and the stock will drop quickly. So the same thing goes if the news is great. They might instead have that fear of missing out, FOMO, right? So they get really excited and they think, wow, this stock is really about to take off. I always thought this was a great stock, but with this news, it's sure to get moving. I got to get in fast and buy. So you have the sellers and then you have the buyers, right? So that disruption is actually called a breakout. So that means something has changed and you've broken out of this new pattern, and there's either going to be a new uptrend going up or maybe a new downtrend. And you might also have what's called a false breakout, where it breaks out, but it's not really due to supply or demand or market sentiment or anything. There's just something that's causing a short-term disruption to it. And that could be something that's related to position squaring by big players like institutions. They might be adjusting their holdings in a particular security that's causing some disruption in the market versus some more legitimate news. So let me give you some examples of what the big players do to cause disruption and potentially lead to a false move or breakout. So let's say you're a fund manager, a mutual fund manager for the S&P 500. And because of that, you're forced to buy Tesla because they're being added to the index. So they weren't in the index prior, now they're getting added. And now you have to buy the stock because of their addition to the index. And it's not because you think it's a great stock or anything. It's just because it was added to the index, so you have to do it. That's going to cause an unusual amount of buying and could change that breakout because all of a sudden there's buying for reasons beyond, let's just say, market sentiment. Another example is Apple announces that it's going to buy its own stock back. A big purchase as part of the company's stock buyback program. So they're going to buy their own stock back. So that means they're coming in and they're actually buying stock on the open market. So if you think Apple is coming in to buy a whole bunch of stock, that's going to drive the price up. So that's, again, nothing to do with individual traders. It's a big player coming in and being disruptive. And a lot of times institutions take advantage of this kind of news to unload their positions onto the public. One more example would be, let's say a fund manager of a big technology mutual fund wants to lock in gains before the end of the year because that's how they're evaluated. I mean, that's how they get their bonus rate. So they want to lock in a nice bonus. And they just had a big run up in Tesla stock, for example. So they want to sell a ton of their Tesla stock so they can lock in their gains for their annual performance and get a nice bonus. Does that have anything to do with whether or not Tesla is a good company or a bad company, or whether technical analysis says that we should buy or sell it? No. It's just a fund manager who's a big player who wants to get his bonus. So sometimes those things can happen. It's not often, by the way. It's not something you have to really worry about, but just understand that it's out there. And sometimes when you see movement and you see something like there's a big announcement that might be related to it, you want to say, okay, is this really happening, or is this going to be some sort of short-term thing and it's going to pull back? In fact, we call that pullback retracement. So a breakout is when a stock breaks out of a range and is now forming a new type of trend, whereas retracement is when a stock breaks out a little bit, but it's a minor move that's going against the trend and it just comes right back down. So if traders think a current move has gone too far, it might have a little course correction, a little pullback, but then that trend should continue up again. And as we learn through the indicators, we're going to learn how to spot breakouts and retracements and how to kind of use them to confirm things to see whether we're seeing a breakout or a retracement. Is it a true move, or is it some kind of temporary type of false move? And sometimes you might see a retracement because, for example, a majority of who wanted to get involved with a stock may have already gotten involved, causing some sort of overbought situation when everybody who wanted to buy has already bought, so it's extended. So then a natural pullback follows. Same thing if something's oversold. And we have these tools that can really help us with that. One is the stochastic oscillator, and there's other types of tools and things we're going to learn about as well. And another way to look at it too, just early on, if you see volume rising, so at the bottom of the part of the chart, if you see volume rising and there's a lot of trading activity, but there's hardly any price movement, hardly any price increase, then that move that's currently happening is more than likely ending. It's starting to basically stall out. So think a stock has been rising in an uptrend for a while and it's starting to receive less and less support and begins to slow down, which means it might be time for either a temporary pullback or retracement, or possibly a move in the complete opposite direction. And we'll continue to build on this as we progress. So breakouts and retracements, they're actually very normal, as we've mentioned, and normal continuation of a trend or just a temporary change, that's all normal. But there are those that are unethical and try to manipulate situations and manipulate the system and really try to manipulate us as honest people. And how they do this, one way is that they'll make up their own news, or they'll spread rumors, or they'll give some kind of dastardly recommendation, or they'll use unfair trade practices like insider trading. Whatever it might be, they're just trying to do something that's not ethical in order to influence the price and try to get others to kind of be tricked into that. So you just need to be cognizant of the fact that that stuff does go on. Now, governments are out there with regulations on things to help protect us, particularly things like insider trading. If you're looking at stocks or things that might be, manipulation of currency or whatever, these types of things they regulate. So let's say, for example, in the stock market world, a CEO makes a statement in an attempt to raise the company's stock that's a false statement. Then there's laws against that, and that person can be punished for it. So if they are a CEO of a drug company, for example, and they say, we have the cure for cancer. Well, if somebody says they got the cure for cancer, that stock is going to go absolutely wild, right? It's going to skyrocket. And then that CEO retracts that statement shortly after and that stock falls. But meanwhile, that CEO and others who he's friends with position themselves in the stock prior to that statement, and then they sell it right after the news, they get out, and then that stock inevitably falls back down. So they obviously lied and manipulated the market, which is illegal. Now, another practice is when someone of influence posts false things in effort to raise the stock's price artificially, and they try to sell for a quick profit. And that can be just regular traders putting out rumors or theories or ideas that they really have no basis of fact on, and they're trying to just manipulate the price, really. And there's a term for that called pump and dump. This is a nice graphic that kind of gives you a play-by-play of how these pump and dumps generally pan out. So let's say you're back at this price level labeled pre-pump value. right? And you want to pump up that price. So they're usually going to talk about things like the next hot tip or the next big thing or whatever it requires to pull in as much attention as possible. They almost will come off as like salesmen. And you might see people posting blogs or post things on forums, and they'll say things like there's definitely a breakout coming. It's about to go to the moon, and you know you need to get in now before you miss that opportunity. And they'll promote that all over on forums, blogs, or YouTube, wherever they could possibly get it out there on social media. And they really have no basis of fact. They're just trying to basically trick people to buy and raise that price. You see it a lot, especially it's especially common in at the top of bull markets. So it was like rampant in 2020, 2021. By the way, if you decide to start applying this and you want to trade very inexpensive stocks, like very, very inexpensive stocks, like penny stocks or a lot of cryptocurrency, especially in the altcoin world, not so much Bitcoin, but more of the newer coins that are less understood, those that are lower priced is the idea. They can be manipulated a lot easier. And that's because there's less traders in those areas and the price moves can be more dramatic. Going from 10 cents to 15 cents is a big move versus trading, let's say a stock trading for hundreds or thousands of dollars. So always consider the source when you're starting to see these things like hot tips or whatever. But the idea is that they take something that, let's say, is now trading for 10 cents and they keep on promoting it and attempt to drive that price up to, let's say, 80 cents, right? That would be right around where on this chart it's labeled schemers sell out of their holdings. So they dump it, they sell it, they get out, right? And they get out right around the top. And then maybe after falling a little bit, they say, oh, maybe it's not that great of news after all. And then the stock just plummets. But meanwhile, they made their profits. So that's pumping and dumping. So just be aware of it, especially on things that are more narrowly traded like penny stocks and alternate coins and things like cryptocurrency. But really it can occur basically anywhere. Even though we're trading individual securities, it's good to always be aware of what is the general broader market sentiment. What is generally happening in the markets? Are they moving up? Are they moving down or sideways? What's going on in the bigger market? Because the individual security will tend, not exclusively, but will tend to follow the market trends. Think of it kind of like rising tide lifts all boats, and the same thing when the tide falls, all the boats go down. So it's a similar thing with prices and securities, and there can be headwinds and tailwinds that you're fighting against. So understanding the broader market sentiment can be very, very important. Again, if we look at just this chart from the COVID years, you could see where even though you have these very different industries, Apple, which ended up doing very well, and Carnival Cruise Lines, which did not, you can kind of see in the broader market, which is the yellow line that I've circled, they've kind of stuck together in a way. You could see where that yellow line, which represents the broader market, right? It's the S&P 500. You could see how Apple stock in the teal and then Carnival Cruise Lines in the red kind of always move in the same general direction. They may not match up to the T necessarily, but it's pretty close most of the time. Sometimes stocks outperform the broader market, whereas other times they underperform. So you could see here, Carnival Cruise Line was underperforming for much of the time, and Apple was doing the complete opposite. So understand that broader market sentiment can be very impactful and maybe something you want to factor in when trading. So sentiment indicators, and we'll cover some later on in the course, like Bollinger Bands and other ones, can help strengthen your decision making as far as what you want to do. And in general, if an individual security is going, let's say, with the market sentiment, that would be considered a good thing and could help you to factor that in. But if it's going against the market sentiment, that would be something that you would just want to take note of and make sure you're aware of. It doesn't mean you can't trade them. That's all part of contrarian investing. In fact, that's where sometimes the best opportunities lie, which is going against it. But just understand that you have this broader market sentiment out there. And there's some indicators out there too, like in stocks, there's a thing called the bull and bear market ratio. It primarily looks at USA stocks, but you may have a similar thing as far as with other markets too. And it's basically just tracking your several professional financial advisors or finance professionals And weekly they publish data by a firm called Investors Intelligence that tells you whether there's more people who think the market's going to go down, so bears, or those who think that the market's going to go up, which would be bulls. So they have this flat line of 0, and if there's more bulls than bears, then the number's higher, and by what percentage? And you can see here in this example at the far right, the bulls were exceeding the bears by about 13%. It's not a super great gauge, but it gives you a general idea. And another one would be the advanced decline ratio. You're really just looking at a number of stocks in a particular trading exchange, whether they closed higher for that day or they closed lower. And you kind of do the math as far as, what's the ratio on that. Here was an example where on that day, 1900 advanced and 1344 declined. So the advanced decline ratio was 1.43. You just get that by dividing the 1344 by 1900. And a bullish sign would be anything that's greater than 1.0 with anything less than considered bearish. So you're kind of comparing that to the previous trends and numbers and things as far as to get an idea of overall market sentiment. But we have some actual indicators coming up that I think will be even more impactful. But these are just some things that will help you see what's kind of going on under the hood with regards to the broader market. One thing that's very impactful to look at and something you should always be aware of when looking to trade individual securities is volume. And I really can't emphasize that enough. Are there a lot of people trading something, or is it kind of low volume at a particular time? And you're looking at that volume over a period of time. And high volume can actually help confirm a price move. They kind of go together, whether up or down. There's a lot of trading that's driving that action, and sometimes the volume can lead the price when something is coming. There's a lot of people trading because they're expecting news and earnings announcement, an announcement of some sort, or there's just something going on that's indicating something big may be happening. So people are getting in or getting out, and volume can help precede that. Sometimes it trails, but a lot of times it may precede it. And certainly when the event happens, that's where we might see a spike in volume too. Like we look at this example here of Carnival Cruise Line during the COVID period, it was incredibly reliant on COVID-19 news, especially if it was positive. And you can kind of see where it had these big spikes up. You could see the volume go with it. I mean, the first spike was a big spike, and the volume did go up. The bars did get higher on the bottom, but it wasn't a real significant difference relative to the previous days. And it ended up just falling right back down on even bigger volume. The same thing where volume kind of goes up in that big tall one in the middle, the third one to the right. You can see there's a whole series of bars below, before and after, from the COVID-19 news. Maybe that was around vaccines and things. That's looking like mid-June here in 2020. So you kind of get a feel for that too. That would really dramatically impact a particular cruise line stock, because until COVID is under control, people aren't taking cruises. So does that impact anything else as far as other stocks? It could. But, particularly for this one, you can see how volume could be a good indicator on that. And as we go through some other indicators, you might see volume tied really well into them as well. All right, so we've got some foundational concepts here, but now let's get into the detailed stuff. That's the indicators. These are the tools, the things we're going to actually use to help us make decisions around securities, like to buy or sell, for example. And indicators are really kind of at the heart of technical analysis, and really are technical tools that we're going to be using to help be successful in the markets. And the indicators are all based on things like math and data, and all that is very focused on trends, of course. You want to kind of anticipate trends, then make your decision based on where things are headed or where the trend is headed. And technical analysis and using indicators is also all about eliminating emotion. You're not tied into, oh, I love that stock, or I love that last movie from Disney, so I'm buying the Disney stock or whatever. Or I heard great things about Bitcoin, or whatever it might be. It takes emotion out of it. So it's what is the indicator telling me versus, my likes or my dislikes about something. And that makes them very, very good to use in that manner. To remove emotion from the equation. Now, they're not perfect because nothing's perfect. If there was, I would have one lesson and it would be about what's the perfect indicator to use, and that would be it. But they have different applications and different ways you can use them, and some work better than others, or in certain situations or certain types of securities. And we'll go through that as we progress through the course. But just be understanding that nothing, of course, is perfect. In fact, really be aware of anybody who says, I've got the perfect system or the perfect set of indicators or things of that nature, because they don't. Sure, some might be helpful, but just be aware of anybody trying to sell you something for money. That's the perfect answer to that. It's probably, actually, it is fraudulent because there hasn't been a perfect indicator out there yet. So indicators at their heart, what they do is they're technical tools that help distinguish between noise and an actual event. Okay, so what is that? An actual event is something that's real, something that's happened either with the company or organization or a currency or globally. Whatever it might be has happened in a broader sense or specific to that security. And it's a real live event that's going to make a change that's going to happen with trends, whether they're going up or down or sideways. Something that is a real change versus noise. So noise are things that are not dramatic and they don't have the ability to change the overall trend. It might cause, a bit of a blip up and down a little bit, but it's not going to actually dramatically change the trend. Whereas an event definitely does have that dramatic impact and does change the trend or might strengthen the trend that's already current, whichever way it's going. But it's not a temporary thing like noise might create. It's a real thing. So that's the difference between noise and events. And indicators help us to separate that out so we can kind of tell what's true and what's false and what might be, really the core things that we want to focus on as far as making our buying and selling decisions using indicators when events happen. So let's look at an example of these noise and events. So for example, let's say you have a drug company and they say that the new drug that they've been working on, that its launch will be delayed by 60 days. So that will cause the stock price and things to go down for that particular company. It is legitimate and it might go down temporarily, but it's more noise, as in, they're going to be fine in 60 days. They were just delayed 60 days versus something that's a significant event where, let's say that same thing with the new drug fails a government approval trial. Now that's a bad thing for drug companies. That means that they might have to start all over. They might just have to pull all the research and development around that drug. Something wrong is happening and it's going to cause a significant change in the trend. In this case, it would probably cause a significant downtrend based on that event. So one is a lot more impactful than the other. So you get a feel for the difference between events and noise with time, and the indicators again help separate out the noise. So we think what is an indicator, defining it, so to speak. And an indicator is a line or a set of lines or some type of mark you put on your chart to identify events and clarify and enhance the investor or trader's perception of the price move, and are looking for things like, is the stock price trending? Is it going a certain direction? How strong is the trend? Is a trend turnaround point about to be reached? So that's what our indicators are telling us. Which way is the trend? How strong is that trend? And is that trend going to change or go maybe in a different direction now? If we know those things, then we can make buy or sell decisions based around the indicator or maybe a set of indicators to help confirm between primary and secondary indicators. And another way to look at this is, what do indicators specifically kind of try and identify? They're going to try to identify, is a new trend beginning? How strong or weak is that trend? Is it likely to be a weak trend or is it going to be a really strong one and we want to get in that trend, whichever way it's going, up or down? Is the trend retracing? Is it just a temporary pullback but it's likely to resume, let's say, for example? Is a trend ending and may change or reverse or go the opposite way, basically? And also we can use indicators to indicate a trading range, high to low. What is the range that's going on with a particular security as far as the pricing in there? And that'll help us decide, again, all these things are designed to help us as far as whether we want to buy or when we might want to sell. And if you look at each of these things, and all these different sections we have coming up are going to start identifying these things. And we'll apply concepts like these different indicators. Like for identifying beginnings of trends, we might use a moving average crossover, momentum indicator for strength of the trend, and relative strength index to figure out if it's going to retrace but then likely resume the trend. How can we identify that? We use the RSI, or the relative strength indicator. So you can see we've got different ways that we can use these different indicators to help us decide what we want to do. And ultimately what all this stuff that we're going to learn is indicators are designed to provide us buy and sell signals, or at least a warning that something might be happening, to help us to be better traders, to be better investors, to make better decisions overall. And really, if you look at these different types of indicators or signals, buy and sell signals, a warning or buy or sell signal, there's really three broad ways you can kind of look at these signal types, and those are crossovers, meeting a range limit, or things converging or diverging. So just to highlight some of the things you're going to learn in great detail coming up, basically a crossover is when one line is crossing another, or price. It basically means price is breaking out. So you can kind of see in this quick little example, there's this trading range where the bars are stuck between a range and everything is kind of narrowly constrained. But the bottom right, you could see where it broke through that range. It broke through that kind of artificial line we put there. That's showing you that price is crossing that line and breaking out, and that a new trend is forming. So there's kind of a big, broad aspect of that. And then you have these ideas of convergence and divergence, where two things are coming together. Prices are narrowing. They're starting to get closer together within a trading range, and sometimes they're diverging or getting further apart. You can see time going left to right in this example, and price going up and down as far as height. And you could see convergence where prices are starting to get closer together, and divergence where prices start to get further apart is the idea behind that. So these indicators are these broad concepts, and we're going to put all this together. We're going to learn a whole bunch of different indicators and different ways that we can analyze investments and analyze securities, so we can make the best decisions by using these indicators, by using these tools. And that's where we'll start learning it and building from the foundation up.